Okay, so what we're going to talk about today is all about VIX volume volatility. I think the first thing to remember here is don't panic. Okay, volatility is good. It's a way of making money. Don't listen too much to the so-called experts. This is nowhere near an Armageddon, Bearmageddon, what they're calling it. The Black Monday crash. We're so far away from that. It's untrue. The media loves to create a stir, don't they, and sell some newspapers and sell some advertising space by making this out to be something that it's not. There's absolutely no point in getting too caught up in what the media tell us. We can all see what we need to see on the screens, okay? So there's no point listening to useless statistics. Trillions wiped off the Chinese markets, okay? Chinese markets are down. Absolutely. Yeah, I'll take that on the chin. But, we're still up 35% from this time last year. So it's not the end of the world just yet. Obviously, all the things I've talked about for the last 18 months pretty much have all revolved around interest rates. And now we've got that real battle now of the Fed keeping to their policy or whatever they've told us, with this very, very loose forward guidance that they're trying their best to normalise rates. When they say about normalising rates, we're talking about 5%. It might take 10 years. It might take 15 years to get to 5%. Who knows? We're going to have very low interest rates for an extended period of time, but we all know at some point they have to go up. It isn't going to be China that breaks the US's back. It's not going to be the UK's downfall either. Interest rates, the reason why we've held off on interest rates for so long is because it doesn't matter if you're Mark Carney, Janet Yellen, Mario Draghi. Nobody knows what's going to happen when interest rates go up. And we're all saying about what interest rates, well, it's only 0.25%. What does it matter? People are so highly debt leveraged in the UK, with the property, the cards, loans, and all these other kind of things. Real wages haven't gone up in comparison with inflation and real cost of living. So when it comes down to it, even a quarter point, hike in interest rates is going to be significant to a significant proportion of the population. And it's always poor people, isn't it? It's poor people, unfortunately, because poor people go to, payday loan sites, take things on credit card for granted and buy things on tick. Rich people just don't do that. Okay, but the trouble is the gap between the rich and the poor is as wide as it's ever been, and there are a lot more poor people than rich people. We know that. So when the interest rates go up, even if it is by a quarter of a basis point, it's going to have absolutely far-reaching effects to large swathes of the population. That's much more important, much more worrying than anything that happens in China. China was going to carry on at 8% GDP forever? Nonsense. Rubbish. How can it? It's run by a lot of communists. It's still an emerging market. These people are clueless. We've got, second, third generation of people that have just, been able to drive cars. So these people are not the established Western economy. And, you have to realise that if you're thinking the world's engine is China, which is, again, still a very emerging market, then we were stupid to think the world could carry on like that. We've learned very few lessons from the crash, and all we've basically done. I was listening to Channel 4, some other woman muppet wittering on about wittering stuff, and she had a good point though. I'll give her this. She said basically the QE and the low interest rates have been keeping the economies on life support. We haven't done anything to change people's attitudes. We haven't done anything. We haven't done anything to kind of really, change people's, spending habits, change people's opinions, and change the way people live their lives. People still want what they want now, and they don't want to wait for it. And I think the only reason why we've not seen any kind of major revolt in the UK, and the way, that obviously the Tories and Cameron got back in, because he talked about, the things that voters wanted. Older people, they still wanted the NHS, they still wanted the pensions, they still wanted the house prices to rise. And Labour threatened all these kind of things. So that's why we got, the votes that we did, and it was a bit of a surprise election. But then again, it wasn't a surprise. If you're saying, to people in council houses, that we're going to take your money away, well, they don't care, do they? Because if they're going to care about it, they're going to get themselves a job, do something about it. They're not going to care enough to go and vote for Labour to change the opinion. So I think what's happening now is that, there's so much volume, so much, the VIX, which is, an indicator of risk or fear, and so much volatility, because nobody knows, okay? Not even the great Steve Ruffley knows what's going to happen. I predicted most of the things that were going to happen, and have. Again, like the inevitable sell-off in the indices, gold, getting away from the highs towards $1,000. We've seen a bit of a bounce in gold, but again, that's still a short-term bounce for me. Anyway, what we're here today is to talk about, what I'm going to start with is the basics. People are forgetting the basic rules of trading, dealing with risk and getting involved in markets when they're moving around more than they have done in the past. So I'm going to go over initially is a basic reminder of risk, how we approach money management in volatile markets. Then I'm going to switch over. I'm going to go through the VIX chart so we can all understand what that's all about and why it has very little relevance to anything. But again, it's something that people have asked me, to explain and understand it further. And then I'll go through some markets now, and I'll show you what actual volume volatility, and what it's all about, and show you that it's actually not as bad as anybody makes out. It's just normal trading conditions. A little bit more volatility and volume, I guess, than normal in an August period where people are on holiday, but it's nothing out of the ordinary. Okay, it's certainly nothing out of the ordinary. Is it extraordinary market conditions in some respects? I guess yes, because we've got interest rates going up in the US at some point, in the UK, we've got China struggling to carry on its growth, we've got all these things that never happened before, but these are all the problems we've made for ourselves. So it's just another phase in history that we're going to have to try and battle our way out of, but we have nothing to kind of go back in history to learn from because we've created it ourselves. So that is why the market conditions are a little bit harder for people right now. Excuse me. So before I start, the risk warning. Remember that spread betting and CFD trading both carry a high level of risk or capital with the possibility of losing more than initial investments. The products might be suitable for all investors and only intended for people over the age of 18. Please ensure you're fully aware of the risks involved. If necessary, seek independent financial advice. And education only. Content the webinars, personal opinion of the moderator and Intro.com. Contents don't constitute financial investment or tax advice. Your advice discuss your specific requirement with an independent financial advisor prior to entering any bet. Intro.com is not responsible and disclaims all liability of the content or comments made during this session. So money management and trading in volatile markets. The key to successful trading, a lot of people forget, right? The biggest reason people do not make money in trading, and it's quite simple, they let the losses exceed the profits. Now, we've all been guilty of letting a trade run a little bit further offside than we wanted and taking that big hit. And that, does happen in trading. But we have to understand that it's day in, day out, banking money, banking money, banking money. Take a hit, part of trading. Carry on trading, okay? So I've gone about a 4.5 month run since I had a big hit. I had not a big hit yesterday, but I took a hit, but it was only 4% of my account. So now my mission is to make back that 4% and carry on trading. The loss is going to come at some point. That is part of trading, but it's how you deal with it and the size of the loss that, that's relevant to what you've been making and the size of your account. Sounds obvious, but traders love to run losses further than they run profitable trades. I can guarantee you, in the last 20 trades you've done, you've got out of your trade for profit too early, but thought it doesn't matter because I've still made money. But you've always let, a lot of the time, you'll let a trade go even that little bit more offside just to say, what if? If only. Maybe if I just hold a little bit longer. And these are the things over a long period of time, of days, weeks, and months, which your trading career is, that will cost you money. If you just stopped out every time for an absolute finite stop over a period of 3, 6, and 12 months, you would be much more profitable in your account. Now, you can say, I don't believe you, Steve, or I don't think that's the case, Steve. It is the case, okay? Because I used to run the biggest trading floor in Europe, 144 traders. I did this exercise with about 60 of them over a couple of years, and every single one would have made more money, okay? So these are professional traders, so that can be applied to us, okay, retail traders. I guess, you got to think, are you a disciplined trader or you're a rogue trader? There's always that rogue trader that goes to make on the big money. You'll see him probably on Facebook or on the news or whatever. Who cares? You don't want to be that person. You want to be the boring retail trader that just gets in, gets out, makes money every day, and it doesn't wow anybody. Stay under the radar, okay? Understand that making money is part of your job as a trader, okay? But it doesn't always have to be the big trades, okay? The majority of your money will come from banking and compounding them small, manageable wins, okay? That's how winning is done in trading. I guess the simple statement, if you don't look to make more profitable trades and losing trades, in the long run, you're doomed to failure. And that's when you get to the point where you erode your capital, or you do a silly trade, or you do a Rio trade. And, these things happen. They happen to traders every single time. They happen to every single, every trader has gone through the entire emotions, the entire things that you have felt in a day. It's happened to traders all over the world. There's nothing new in trading, okay? The Rough Guide to Trading is ready. I've got a copy of it on my table. My desk just here. It's going to be ready for you guys to buy, very, very soon in the next kind of few weeks. And it's all about understanding your place in the markets. There's nothing you can think of. You cannot reinvent trading. You cannot reinvent technical analysis. You cannot reinvent fundamental analysis. You just can't. It's been tried. You can't do it. Okay? And what you have to understand is, well, if you can't do that, what can you do? Well, be in control of yourself. Okay, so these things, that the reason why people hold unsuccessful trades longer is because they're frightened. Well, you have to do something to take that fear away. So what is it you do, trader X, Y, or Z, to stop feeling fear? Is it you use a guaranteed stop? Is it that you get out for an exact amount of money you can always afford to make back in the next few days trading? What is it that takes away your fear? Because all the markets are designed to do is make you think you're wrong. Yeah, make you think you're get that fear into the markets and make you think you're wrong. 9 times out of 10 we're generally right, but the market's job is to make us think we're wrong. So I think for me, it's the poor rules. If if you're just winging every trading session, and you don't have any kind of idea of what you're trying to achieve, and you don't have them rules, then one loss can get away from you. I've had trades very, very far offside, but again, I've held them for the right reasons, and maybe I've still taken a loss. But it doesn't matter. It isn't the big loss that the market wants you to take, where it wants you to take all the fear. Okay, markets go up, markets go down. Simple as that. Okay, you have to understand in what period of that movement and that time that you're right or wrong. I guess fundamental news, we've got to figure out in 19 minutes, so hopefully you might have a bonus trade there. And again, people not being aware of these fundamental news events or key data or key speaking events, it's going to catch people off guard. I was sat here yesterday, out of the blue, China cut rates. Brilliant. Sell some gold, buy some DAX. Thank you very much. 2% of my account in about 3 minutes. Okay, could have held it all day, made it much more, but didn't matter. I was listening, I was ready, I knew what to do. These are the things that are going to make you a successful trader. And just having the wrong opinion. I think people sometimes just assume because they've read something in the FT or they've listened to something on, Bloomberg News, that that's going to then happen. Yeah, it doesn't. Things take longer to filter through to the markets than you might think. Some things will happen quickly, some things won't. Okay, that is the fundamental side. And that's the 20%, 80% of the time, we can all see the same chart, we can all see the same information. 20% of the time, it's down to interpretation, down to that data, down to them speakers. And that's what we're trying to marry up, okay? So for me, cash management is the key. Once you're out of cash, you can't trade anymore. It's simple as that. So what is risk management? Well, it's the same as cash management. People, again, are getting involved in like listening to things that don't concern them. Okay, if you're a trader, an intraday trader right now, okay, the VIX is as high as it's been in 7 years. So what? Do you ever trade off the VIX? No. You can look at it and it's a chart and it goes bibbly bibbly bobbly bob and then it goes bang and it spikes up the most in 7 years. Well, you don't need the VIX to tell you that things are happening in the world because it's all around us. So, the VIX is just something else that, people like to pull out of the bag of tricks and talk about because people go, oh, well, yes, the VIX. That's very interesting. I was looking at that the other day. Oh, it's gone up. Highest in 7 years. So what? Who's interested? You can see all this information in your charts. I'm going to go to the charts. I'll show you all this stuff anyway. So the biggest mistake people don't understand is capital's king. Okay, if you put 10 grand in an account, you don't want to lose it, but once that chips down to 5 grand, trading starts to become very, very hard. And when you talk about in proportions of account, percentages of account, if you're losing 4% of your account, it's not that bad. You can live with that. If you're losing 20% of your account in a trade, that's not good. That's not good at all because then you're only one other trade away from going to key significant levels, like a quarter of your account being drawn down. So I think a lot of people, again, don't look at their money in the right kind of way. Money is there to facilitate you. Okay? The more money you have, the more money you can make. The less money you have, the less money you can make. It's as simple as that. The markets are very clear. You have to have enough margin to cover all your positions in the market. So if you're trading £1,000 account, you could probably run £2 a trade. £2 a point. If you've got a £250,000 account, you can do £250 a point. Okay, it's all relevant. Okay, so you have to be understanding that your capital is. I don't know. People will think that I only put 10 grand in the account. If I lose it, I'll put another 10 grand in. It's only 10 grand. Once you start to think like this, you've already lost your money. Okay, you've already lost your money. So what you have to think back and understand is, what you're doing right now, each trade, is not about the gambling mentality. Well, if only I had a bit more time, if I had a bit more money, or I could just average a bit more, I'd never lose money. Okay, it doesn't happen that way. You've got to think that all the money in your account is what you've got to play with for that moment in time. And you can make money with it or lose money with it. That's as simple as you have to make trading. It's not about what you can do outside of it. It's about that split second in time. What you can do with your account, what you can do with your risk, what you can do with your own personal interpretation of the markets, and not getting brought into that fear, controlling the fear and being able to rise above it and make money from difficult situations. So you got to act like a pro even if you're a novice, okay? Beginners you mean to go on. I can teach anybody to trade. I can teach anybody to trade. It's the easiest thing in the world. Buy, sell. All the difficult things come with controlling your emotions. It's all about emotional intelligence, okay? There's 4 things that generally crop up time and time again when I've taught traders, okay? And we'll come to them in a minute. But I think that the main thing is you've got to avoid excuses. If you ever say, if only, if you're talking to your wife or your girlfriend or boyfriend or whatever, and you think, well, if only I'd just done this, or, if only I got in earlier, there are no if onlys in trading. The markets exist, 24/6 for your pleasure. They will move whenever they want, and they don't even know you exist. So there are no excuses. If you are right and you made money, pat on the back. If you're wrong and made money, even better. But if you didn't make money and there was a reason you think why, well, there is no reason. There is no reason, okay? The only reasons are down to you. So again, remember, the market's not against you. I used to have it all the time on the floor. People would say, is there a camera on me? People saying, why? Why is it me? Because as soon as you said that, again, you've already lost. You're not thinking like a professional trader. You're thinking like a mug, okay? The market doesn't know who you are. It doesn't care. It's performing a function. Only you can control what you do. And again, except you're not going to get the markets right all the time. Yeah, put it into ratios, put it into number of trades, whatever. Okay, 8 out of 10 trades you're going to win. The 2 you're going to lose, but then 2 cannot outweigh the 8 that you've made. So I mean, it's obvious. I mean, it's simple when I say things like that. But when you get involved in the markets, you see the volatility, you see the volume, you experience the fear. All these rules go out the window. So if you're not prepared with the rules beforehand, how can you possibly expect to trade these very challenging, very volatile markets? So the 4 steps you've got to look at: preparation, entry, target, stop. Make trading as simple as this, okay? Informed is forewarned. Have an understanding of what's happening out there, okay? Understand that, yes, the markets have sold off, but I'm looking at the DAX right now, and it's towards the daily highs. So we've seen yesterday had a nice bounce, so is that going to continue? Well, think about the reasons why it could or couldn't, okay? Understand the fundamentals and technicals. Entry level. Don't rush in, okay? Wait for the optimal point. I know it's very difficult to do that, but you can refine it over, your kind of trading career. It gets easier the longer you trade. Target level, just as important as your entry level. Okay, understand where the market, can get to and get out at the top or the bottom. Okay, how many times have you tried to press the button to get out and hesitated, and then you've just seen your money chip away, going away from you, back to half your profit, maybe even back to a scratch. Okay, the market's so volatile and so quick. It's just as important to know where you're getting out as where you're getting in. And stop level. Now that can be monetary, it can be a physical stop, it can be a trailing stop, it can be whatever you want. But understand when you're wrong in a trade. Yeah, that has to be a point that's in your trading plan. So the preparation, don't just log on and trade. At least do a bit of research. Just flick through Bloomberg, the FT. There's so much out there. Twitter. What the currency pair's done overnight. I'll show you my main screen and the correlations. Has the market done what you expected? Again, what's data coming out? We know in 12 minutes we've got some retail sales. What do we expect? Is the market trading technically? Or, what are the big levels? What are the big levels where the market can get to? And then the value of weekend analysis. I think weekend analysis is where you can kind of sit back and just figure out what's happened in the week and if you gauged it right or wrong. A lot of people, again, try to make trading overly complicated. Markets will go from the low, they'll go to the high. They will move in correlations, currencies will move in coefficients, and then they won't. Okay, so you understand why things are happening. At the weekend, you can take a step back and figure out why things have happened, because generally you won't have positions on. That makes your mind clearer. So that's a really good tip. Take Saturday morning or, Sunday afternoon and just have a look at the charts. Okay, when they're not moving, understand where value is. Understand what can happen on Monday and Tuesday. Understand what could happen, to shape the world over the weekend. Having no positions on really does clear your mind, and it really is a good time to take stock of what you know has happened on the charts, because they're black and white with them, especially them daily, weekly, monthly, closes. But then think what can happen in the future. So entry level, and I guess it depends on your trading style. You might be a swing trader, a scalper, yada yada yada. I'm not going to go into too much of this because this session's not about this. You're just a momentum trader. Okay, we're all a short-term momentum, medium momentum, or long-term momentum. We're trying to get the market on the way up or the way down, and the period of time, is just the amount of momentum that we're experiencing. So think about it that way. Swing trading, whatever, position trading, it's all part of the same cycle. We're just trying to get in the market for as little risk as we can and get our money out, get our profit. That is just following momentum up or down. So target levels again. I mean, think about how much a candle can move in a 5-minute, piece of movement, a 15-minute piece of movement, an hourly piece of movement. Again, people don't look at charts in the right way. I will show you in a minute, which I don't need to kind of go through these slides too much. I'll show you in real time how you figure out, what market target levels could be. Stop level is easy. We've talked about this one. When are you wrong? Okay, so know when you get into a trade, I'm trying to make this target. So I'm trying to make 30 ticks. I'm trying to make £1,000. So what tells you wrong? £1,000 loss? 30 tick loss? Doesn't sound too great, that does it? £500, £100? Think about what that stop is before you put a trade on. Okay, just have an idea. At least you'll have a fighting chance then. So risk reward, again, I've gone through these in different strategies, but again, it's got to be 2-to-1 in your favour, hasn't it? I mean, you wouldn't back a horse, would you? If you thought you were only going to win £50, you wouldn't back £500 to win £50. If you put £50 on, you're going to win £500. Yeah, you would. So if you're trading, if you're trying to make £1,000, why would you risk £3,000? Go back to all these ratios and all these things that we know about. So the correct risk ratio, again, it has to be anywhere 1-to-1 or 1-to-2. So try and make more than you're risking. So if you're trying to make £2,000, risk £1,000. Trying to make 60 ticks, try and risk 20 or 30 pips. Okay, so it's all about, figuring out that ratio, that risk-reward ratio, and keeping it in your favour. I mean, at the end of the day, there's no point taking huge risks time and time again to make small profits, because that's when you get to that point where you're trying to make £1,000 and suddenly you lose £5,000, and that's 50% of your account. So all of a sudden you've gone to the complete opposite of what a risk-reward ratio should be, and you've ended up wiping out half your account for no real reason. Even if you made the trade, you've only made £1,000. You ended up losing £5,000. That's just not good risk-reward ratios. So people lose money because they let the trades go, a lot more offside because they don't want to realise that loss. And that again is just a fear factor in the markets. Why use stops is a guaranteed way of losing, knowing how much you're ever going to lose. So with a guaranteed stop, at least at any point in time you can live to fight another day. If you're not good with risk, or you're not good with the volatility, just use guaranteed stops, because then you always know where you stand. You might get stopped out more often than not, but it doesn't matter. At least you know that the fear and what the market's trying to do to you is not going to affect you as much as other people, because you're always going to get stopped out for what you can afford. And then, excuses. At the end of the day, there are no excuses in trading. We either get it right and we make money, or we get it wrong and we lose money. That is it. If you don't like it, don't trade. Go and do something else. At the end of the day, excuses have no place in the markets. I mean, again, conserving your money in volatile markets, it's all about keeping to the rules and certainly picking your time of day to trade, okay? Trade around figures like we've got now in the next 7 minutes. Trade around the US Open, okay? Or trade in the quiet period and leave your trades for longer. Positive and negative average. I've told you, in these volatile markets, you have to be able to average. You cannot really just take one price and expect to be right, because the markets move around too quick. So if you are using any kind of stop, you just get stopped out too often. And I would say when we are trading volatile markets as we are now, trade a little bit smaller size and then use a negative and positive average to build your size up. Okay, for me, that's the best way to trade these markets. I will never buy one price. I will never sell one price. I will always start off small and build up into a bigger position, because I know the markets with the volatility, are not going to allow me just to press the button and go 50 ticks on side. I'm going to have to take, elements of volatility and pain. And that's what we're trying to, figure out, from this session, how we deal with that. So again, have your rules inside of you. Make sure the rules take into account your capital, frequency of trade, and the size you're trading. And if you know the markets are volatile, then do something about it. Don't trade the way you've always done. If markets are more volatile, absolutely you can make more money, but absolutely you can lose more money. So make sure your rules have changed, to adapt to the market conditions. I guess time of day, for me, I generally see an opportunity after the open. So I'm generally trading anywhere between 10 and 11, have a little break, wait for the markets to get up and get going about 12, half 12 again, and then generally, around about the close, anywhere between 4 and 5. So there are periods in the day which, will suit your trading style, so figure out what they are. And then again, like I said, in volatile markets, I would generally say either start with smaller size and average, or use stops. It's down to you and your trading style. I can't tell you exactly what to do, but you have to use a combination of the both. You can't just use your normal trading size with no stop and expect market conditions to trade as they have done. They're not. Okay, so if you're trading very volatile markets, use a physical stop to know when you're wrong and just get out, reassess, or trade smaller size and average to try and negate that small term volatility. And again, negative and positive average, it's the only way I know how to trade these markets. So I start off with smaller size and I build around areas of interest. I'm not price sensitive. I know that if I hit a big level, I want to be buying anywhere around 20 ticks around that level. And I will buy, 15 lots, 30 lots, 60 lots, 90 lots, 200 lots, whatever it takes for me to warrant, what I think that position deserves. And again, I know my risk reward as in physical stops and money, percentage of counts, etc. And for me, it's the best way to trade. And then manage your size. As I said, when markets are moving more than they used to, then you've got more opportunity to make money. So if a market used to move 50 ticks in a day and now moves 200, then you can cut your size down because you're going to get more pip value out the markets. So the conclusion is, it's about balancing expectations versus manageable losses. Okay, don't expect the market, and try and get it right all the time. It's all about percentages, right? So I'm trying to just get through this so we can get, in time for the figure. So I'm going to share my screens now, guys. So really, that was just a bit of a bit of an introduction, just to risk management and an overview of risk management and all the things that people forget. People love to forget the basics when things are happening. It's Bloomberg said that China's dropped overnight, so the FTSE should go down. Why? Why should the FTSE go down? Okay, why should the FTSE go down just because the Asian markets go down? We're not in them kind of market sections anymore. That kind of stuff doesn't happen. It's not necessarily correlated in that way. People are taking lots of money out of China. Maybe people are putting money overseas. So it's not necessarily direct correlation. All right, guys, let me just quickly go over the market. So as I said, the FTSE looking particularly strong today. So we've bounced. The DAX is towards a very big monthly level up here, just above 10,000. S&P, is really struggling to hold above this big trend line. And again, the currency is looking quite weak in the euro, looking very weak in the pound dollar. That was a good bounce level. I was waiting for that. Shame I missed that. And then the dollar yen again is still looking, kind of strong, because what we're seeing now is people change their opinion. If the markets are going to remain quite tough, then maybe the Fed can't raise rates until next year. Then we see some dollar weakness. And if the Fed don't raise rates, then the UK won't raise rates. So that's maybe why we're seeing this weakness in the pound versus the dollar, because they're talking about rates not going up in the UK until 2016 now. So again, all these things, are very, very difficult to to kind of put into context. But what I'll do is I'll show you in a minute, after this piece of data in 2 minutes, what the markets, are looking to expect. And this idea of VIX, I'll show you that, and I'll show you the volume, that the volume is not actually anything particularly major. Okay, so what we're going to do now is look for our economic data. So we're looking for here, durable goods, minus 0.4 for July, and the X 0.4. So a prime bit of trading opportunities that are going to come up in the next couple of minutes. So again, durable goods, if stronger than expected, you should see strength in the dollar. You should see strength in the S&P, DAX, and FTSE. Durable goods are worse than expected. You see the opposite. Okay, so again, we've gone over a lot from the kind of from the risk perspective, and the volatility perspective. What we'll go through after the data, I'll show you actual volume, volatility, and VIX, and show you real market conditions of what you should be looking for and how you use that to trade, rather than just listening to the news. Okay, so just about 30 seconds or so for this data. So minus 0.4 is the call. Ten seconds. Two percent higher. Sell some gold. Higher than expected. Much, much higher than expected, 2%. So watch that dollar spiking now. Dollar's spiking. So 0.6 expected 0.4, 2% 0.4 expected. So much, much higher than expected. Much, much higher than expected there. Okay? So prior revised up to 0.9. So across the board there, much, much better than expected figures that we saw. So big spike in the dollar yen here. We haven't seen gold really kind of come down now. It's just starting to come down now. Come on. Come on. So much, much better than expected there. So dollar, again, seeing that strength. We're just not seeing any weakness in gold. I don't know why gold is not going down here. So this is the volume and volatility here, guys. I'm just seeing my P&L flick and flick and flick and flick, and you know, just can't seem to get a proper. I just can't get on side. Ah, right, got it. So I'm out now. Gold's going to absolutely tank now, but you know what? I can't keep you guys waiting. So small amount made there, small amount made. A nice big target at 11264. So just a little bit out. Look at the market spiking now on this. So you're going to expect gold now to get tanked down to here, to 1164. Nothing really below that. But the dollar's towards the high spiking, dollar spiking, obviously, makes gold more expensive. Gold comes down. We're seeing the DAX, SMI, FTSE, S&P really kind of spiking on the back of that now. So difficult when the markets are volatile like this, because again, you see your P&L onside, offside, onside, offside, and now it really starts to tank, and we know where the market's going to hit and probably see a big, breakthrough here. So very, very difficult, guys. Very, very difficult when you kind of, trying to trade these volatile markets, because everyone knows what to expect. So we all know that the figure here was expected, at minus 0.4, and it comes at 2%. I mean, 2%, that's like as strong as it could be. So gold should be off 50, 100 ticks right now, but it's not. And that's not because of the volatility, it's the lack of volume. That's the problem. Okay, it's the lack of people, just doing what I've just done, selling gold, because it has to go down. Okay, so it's 2% minus expected minus 0.4. So you know that gold has to go down because gold's a safe haven. Okay, 0.4 for the X transportation at 0.6. That's good data. So good data sends the stock markets up, sends safe havens like gold down, because it took so long to do that. It feared me out of the market. And what you'll see is when you see screens like this, I'll show you gold. Yeah, so what gold did in the last 5 minutes, it went up. Okay, so I'm thinking to myself, well, I've sold, quite a large amount of gold, and again, I'm going offside here, 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 and here, and I don't want to be. So I've held it, I've come down here and take some profit, and the market's gone fine. Yes, well, you take your profit down here, but we're going to break it all the way down to this key level, which we know is a prime, level of interest. So 1162.6, which I pointed out. So instead of, again, making the entire move like I did, I've had to take on some pain, probably made 13 ticks, but I could have made 45 ticks, 46 ticks. But again, it's still money, isn't it? It's still money. that you've taken out of the market. So it might go, down, make some new lows, and continue to fall maybe for the rest of the day or for the next kind of 15-minute candle. But this is what you have to figure out. I mean, gold's come down, so it's 1, 2, 3, 4 selling hourly candles, which, again, we've seen lots of selling 15-minute candles. But really, we've seen more green candles in the 5 minutes. So the market was looking to buy up. So we've caught the market by surprise, which means the market obviously will then go down. People have to get out of long positions, but then it really takes over. But if this particular kind of here we go now. Look at that big spike now in gold. So what we're trying to figure out is what can happen in the dailies. Lots of red candles on the hourlies. 4 hours of selling. So I mean, again, it's all about being patient. When we don't have that volume in the markets, it's very difficult to trade the markets when you don't have the volume, because it doesn't do what you think when you want it to do it. Again, if we were trading that in September, that data, then the markets would be at this point now. 3 minutes ago, it had dropped 50 points in a couple of minutes, because we don't see the volume in the markets right now. What we're relying on is the big traders coming in and going, well, yes, okay, well, gold has to go back down on that better than expected figure. So now gold is tanking. But for me, as a very short term trader, I want to be in for my profit and out. So we could be holding this profit now on the size I was trading. We'd probably be a couple of £1,000 on side. But that's all hindsight. That's what if. What could have happened. I told you I had some data out. I made sure we were there to trade the data, and I made some money. It's not going to change the world. I mean, again, it's just another probably. What would I say that is? Yeah, it's just another 0.5 of my account. So I probably could have made 2-3% of my account today if I'd held that trade longer. But it's all perfect hindsight, isn't it? I'm not here to make excuses. I did the right thing, and I took some money out the markets. That's what we're here to do. So I'm sure there could have been something better to trade. We could have bought some dollar, sold some euro. Doesn't matter. Okay, what I did is what I did. I made some money, and that's what we're here to do. So this is one of them kind of sessions, guys, where we're getting through a lot of stuff. I mean, this is just what I wanted to do for my monthly sessions. Teach people some basics, show you some live market conditions, and show you how the professionals do it. And I'm a professional trader. Don't matter how you look at it. I make more money from trading than I do anything else. That makes me a professional trader. Now, I set some charts up just before we came on, just to illustrate, what real volatility and volume actually means. Okay, so we'll look at some products, and we'll try and get a picture of why the markets are so obsessed and why the media are so obsessed by telling us about this volatility and volume. Okay, so I'll start with the FTSE. Okay, the FTSE, yes. Absolutely, we're experiencing a lot of volume, a lot of volatility. Look at the size of this candle, this weekly candle. Yeah, that's a big chunk out of these previous candles. But hold on, okay, back here, back in 2004, late 2004, yeah, we saw a weekly candle of just over 5,500 ticks. So what's this then? Okay, nearly a year later, okay, that's 4,700 ticks. So not as much. Okay, so we have seen this volatility before. So we have seen a sell-off, yeah, equal to what we've seen now. So, okay, right, so the FTSE's gone down, but it's not actually, panic stations just yet. Look at the monthlies. Okay, we're still in a massive bull trend. Okay, and we've bounced already in this month, bounced already in this week. So maybe it's not the end of the world. What happened when we sold off in this one? Well, the next week we opened up, yeah, came down a bit and then went higher. So maybe, if we hold above this key level here at 6,069, well, maybe then we'll go back up towards 6,500. So all this kind of media speculation that we're, experiencing these huge volumes, volatility, it isn't. We've seen it before in previous, huge volumes, volatility, it isn't. We've seen it before in previous weeks trading in the FTSE. So no. Okay. So monthly, when we're looking at oil, well, hold on a second. Look at the size of these candles in oil monthly. Massive sell-off, okay, and then we've seen a bounce back up. So the size of these candles are nothing compared to the previous selling months, okay, back earlier in the year when oil sold down. So look at the weeklies. Okay, we've seen a downtrend for sure, but this downtrend obviously wasn't going to finish unless oil got back up to significant levels. So yeah, oil's dropping at lowest levels, but look how it's doing it. Tiny little candles compared to these big candles we saw to get it down to these lower levels. So for me, okay, oil might rest about $23. Who knows? Who cares? I couldn't care less. I'm interested in making money. So we're selling off, but it's not like it's the biggest, wildest sell-off I've ever seen. That was happening further back in the charts. So that's Brent, by the way. Euro dollar, another great one. Okay, we're seeing pretty big candles, but all the candles on the weeklies are pretty big. Okay, so not quite as big as these candles back in March, not quite as big as these candles that are setting off, the market, back in, November 2014. So, all right, we're seeing a bit of volatility in the euro, but not really that much volatility. We're in a downtrend. What do we do in a downtrend? We sell high. Okay, so we've not got back to the 50%. We haven't got back to the 38.2. So what do? Sell high. Lo and behold, the euro is coming down. Now, Deutsche Bank, UBS, all the big firms have said we're going to get down to 1.0. Who am I to blow against the wind? We're getting down to 1.0. We're getting down to 1.0. Simple as that. So just sell every high. So the volatility and volume in the euro, I don't see it being that great, to be honest. We've seen lots of volatility and volume in the weeklies all the time. Dailies, yeah, sure, we've seen a few big days. Yeah, back on Friday was a big day, but really, look back in the charts, it's nothing really out of the ordinary. We're not seeing extravagant volumes or extravagant volatility, I wouldn't say. We're moving against the direction of a downward market, so that will, of course, bring people in. But look at these tops here. We're looking to get back into these levels, aren't we now? So the market, breaks below 112.985, below this 23.6, then we carry on the downtrend. So for me, no panic in that market either. So far, everything we've heard on the BBC or Channel 4 has all been negated. Gold, okay, gold's in a downtrend. Okay, market goes up, market goes down. Market hits the 50% and tells us, you know what, technically, I can't buy any more gold. Okay, we've tried, but technically the markets can't hold above it. Tried, lower high, lower high, lower high. Market hits the, like I said, and okay, we've bounced back, but we're still going to hit $1,000. Why? Because it's in a downtrend. So if we're in a downtrend, what can you do? Absolutely nothing. Yeah, all you're waiting for is the market to get to $1,000 because that's a psychological and technical level. So we've seen this bit of a bounce, but we've only got back to where the up move started. So if this monthly candle closes around about here, yep, or the weekly candle closes below the 61.8, we're going to get to $1,000. Lower high, 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 lower high. Okay, history. That's what I use, history. What happened in the past to predict the future? At every high point in the past, market didn't hold on to it. Going back to 2012, market then should go down. If it can't go up, it goes down. So $1,000 is my absolute, nap in gold. So it's going to come down. So again, use what's happened in the past to predict the future. Use your dailies. Okay, every time we get these spikes up and green days, red days come. So we're seeing the green days, red days are coming. Might see some green days back, so make sure you're selling gold high, but then you're going to get it lower. Okay, so that's an example of looking at the volatility and the volume, okay, which people are saying is extraordinary, and it's not. It's just everyday busy markets. Now, we don't see the moves as big because we're in August markets, which means there's a little less people trading because they're out with the families doing normal human being things. So that's why we didn't see gold shoot down as quickly as we'd like to on that durable goods data, because there weren't as many people as me just hitting the button. Okay, but that's a lack of volume. Doesn't mean that we're seeing a lack of volume, in the overall direction of the market. It's exactly as it should be. Okay, so that's something I'm prepared to show you, beforehand. That in the FTSE 100, in Brent, the euro dollar, in gold, we're not actually seeing anything out of the ordinary whatsoever. Now we'll go on to the VIX, and I'll show you, what everybody, is loving to kind of speak about right now. Like, these people really have a clue, and they don't. People are just talking about what they're talking. So this is a daily chart of the VIX. Okay, so the VIX just means it's just a fear indicator, how worried the markets are about the fundamentals, the technicals, and the stability. So we've seen the daily, VIX has gone nice along, then all of a sudden, bang, we've seen a spike in the VIX. But really, if you look at the daily chart, the VIX has been going up, for quite some time. The VIX has been very stable. And what I don't like about the VIX is it's not like the RSI, it's not like MACD, it's not like stochastics. It just kind of takes things into account, and when it goes, it just goes. You've got to, obviously, to the 5-day view. All right, what we're trading now, is that anything out of the ordinary? Look, the VIX has been back up here. It's not really, kind of anything major to worry about. Obviously on the month, the VIX has gradually got high, but it's coming back down. When we hear compounded, effects like interest rate hikes, problems in China, problems in the euro, problems with, personal debt, problems with Apple earnings, all these things come at once. It gets disproportionate. Okay, so when the stock market in China drops, 6 trillion, of course people are going to get worried. Okay, so that's when you see this rise in the VIX. But just look at it, on a more kind of smoothed out term, over kind of periods of like 5 days. And yeah, it spikes up, comes back down, spikes up, comes back down, spikes up, comes back down. So what goes up will come down. Are we over the worst? I don't know, but don't follow the VIX. As in, this is, the VIX is high, sell the market, okay? Because that's not how it works. VIX is just showing you that there's people in the market and people want a gauge of fear. Well, you don't need a gauge of fear. What you need to understand is how the markets are trading. And that comes back to looking at your charts, okay? And your charts are this, okay? So, let's just go back to the overview. The charts are this. So you can see now what the markets are doing. I only trade 8 products because I know them all inside out and I know what they're going to do. So I know if the dollar's strong, gold should be coming off. Okay? If the dollar's strong, then the euro and the pound should be coming off. Inverse coefficient. Yep. A directly opposite coefficient. If this one goes up, these go down. So if this is trading up here and this is trading up here, I'll sell some pound against the dollar because I've got an edge. Okay, or maybe if the euro is high and the pound's low, I'll sell some euro. So it should catch up with the pound and the dollar should regain some strength. Indices, if the S&P is high, Swiss should be high. Yeah, UK should be high. DAX should be high. Okay, gold should be low because these are inverse correlations. Stocks are high, gold goes low. So there we go, guys. I mean, this is understanding, and if there's more volume, volatility in one thing, okay, and you miss that one product, try and trade something else. If this gold continues to absolutely tank and go down like we think it is to $1,000, that might then mean that people start piling into the dollar. So if the dollar's low, you can buy some dollar on low gold. So really, all about these things and figuring out, what's happened in the past, therefore what can happen in the future, and not listening to the media speculation telling you that you should be frightened. Okay, that's for investors. It's for people that I absolutely hate. Okay, little idiots, that have made some money, put it with their IFA. Oh no, the stock market's dropped 10% in a day, I've lost all my money. No, you've not. You're investing for a long period of time. So that can take 6 months to get back. It can take 6 days to get back. Okay, the whole point about people talking about the stock market in ways they don't understand is they don't like big swings. Okay, if something drops a large percentage, it will go back up in a large percentage. That's how the markets work. But it's the time element. What we're looking for is quick trades. I was in that trade there for 2 minutes 44 seconds, okay, and I made a decent amount of money. Not as much as I should have done because we saw gold went to to continue to spike off significantly, but hey ho, I'm in the markets for 2 minutes. You make £500 in 2 minutes. Who else is going to complain about that? Nobody. Okay, that's my kind of work. I take on that pain, I take some offside position, then I take my profit out. Now, absolutely, if I ran every trade for 15 minutes, an hour, or a day, I would be up exponentially more. But that's not how I trade. I don't want to trade long term. I don't want to take risk on. I don't want to invest. So I use my trading ability to get in the markets for small periods of time with as much size as I can, then get it out as quick as I can. So that means that I'm right the majority of the time, okay? But doesn't mean I make the most money, but I'm not bothered. That's my trading plan. That's my style. Quicker the markets move, the better it is for me, because the more happy I am to take money when markets are moving quickly. I don't like to wait and hold for things to happen, which again might be your style of trading. But again, we're trying to figure out the VIX, the volume, the volatility, and why people are frightened. Well, people are frightened because things are moving in large chunks. Okay, so when you hear these big figures and these big chunks, these big percentages, people get frightened. When you look at them on an intraday market or an hourly basis or even daily basis, it's not as bad as people are making out. It's fairly normal intraday trading conditions. Okay, and all you have to understand is if you get a move right, it's going to probably move a little bit quicker, a little bit faster, which is good. But also in low volumes, you might have to wait a little bit longer for the move to come out because there's less people pressing the button at that time. Okay, and that's just understanding the market conditions. The VIX really has very little relevance on intraday trading. We all know people are frightened. We all know people in China are frightened. People in the UK, frightened about interest rates. Everybody's frightened because the media makes you frightened. because that's the media's job, to keep everybody in check. When you look at the dailies and you look at the hourlies and the 15-minute charts, it isn't that difficult. If I show you that gold trade now, you think to yourself, well, Steve, you're stupid though. You should have just held it, shouldn't you? Let the first 5-minute candle close. Of course it was going lower. You better kill him though. Doesn't matter. I've made my money in this candle and I'm out. So people selling it here, yeah, it might be, oh no, it should go down further and they're getting squeezed out. I don't care. Maybe I'll buy it here, yeah, and then get out. Maybe I'll sell it here and get out. I don't know. I don't care. It doesn't matter. I've made my money, okay, and I'm happy with the amount of money I made. And that's what you need to think about. It's not about being right. It's about making money. Okay, now that's a lesson that I've taught you guys for a long time now. It's not about picking the high and the low of the market and being right. If I want to do that, I'll ring up the Financial Times, Bloomberg, Reuters, and tell them. Okay, I'm not interested. What I see is my P&L, my percentage of account, and I'm happy with what I make. I'm happy making money every day. That's what I do as a professional fund manager, risk manager, trader, everything else. I just make money. I might not always make the most, and it might not always be the most spectacular, but it doesn't matter. Time and time again, in and out of the market making money. All right, guys. Well, 51 minutes of talking. We've had an introduction to risk management, trading volatile markets, some ideas that we forget. We've had a live trade and made some money. I've gone through some prime examples of the FTSE, of Brent, of the euro, dollar, and gold, that the markets are not actually, as volatile as the media is making out. We've gone through the VIX. Yeah, for sure. It has some. It's seen a spike, but what do we do then? What do we do with that VIX? Well, we don't do anything. We take it into the market and we let the markets tell us what they're trying to achieve. Yeah, cheers, Sep. I've still got a little bit of a tickly cough, but I'm not going to let that stop me. All right, guys. If you guys got any questions, then is there any products you want to go through? Is there any products you've been caught out on? Again, trying to pick your levels of where the market's going to go to. But be realistic, okay? So we've seen 1, 2, 3, 4 hours of selling in gold, and we're below this monthly level. Where's it going to go to? We've seen 3 days of selling. Is it going to get back down to 1115 spot 5? Probably not. So even though we've seen that really, really good durable goods data, I don't think gold's going to finish on a low. I think gold's going to probably rebound higher before it gets lower. So again, maybe do a Fibonacci on the 15-minute. So look for that 50%. So if gold gets back to the 50% and looks to rally, then maybe buy above. But if gold doesn't hold above the 50%, then maybe it look to make new lows. But look on the indicators. Gold's a big, strong buy here. Yeah, we've had 3 days of selling. So don't sell at the bottom of the range. Try and sell higher. Okay? Be a bit more pragmatic. If you want to sell gold now, yeah, sell it after green candles. Don't sell it here. Because then profit taking comes in. You're going to have to take, if you're selling it towards the lower of the range, then you're going to have to take pain on. That pain is 34 ticks. That's a lot of money in gold. It might go down and make some new highs for sure, but you don't want to sell it here. You want to be selling it high. Yeah, and that monthly level seems to be working quite nicely, doesn't it? So again, look at your markets on different time frames. Daily, hourly, 15-minute, 5-minute. Figure out the right optimum point to buy and sell in time. Give yourself a fighting edge, doesn't it? That's what you have to do. Okay, Matthew, do you bother hedging at all? No, I don't, Matthew. If you find yourself hedging, unless you've got a sizable 6-figure account and you're trading heavily commodities, I wouldn't see the need to hedge. Hedge is just really doubling up for me. If unless you're a very, very big trader, hedging is not for retail traders. Hedging is one of these things. It'll work for you once, but the other, 4 times out of 5, it won't work for you. So no, I never hedge. I will always be in the same market. So again, here, yeah, I was selling I was buying the pound against the dollar about here, okay, because I thought this level I expected to break, and so I had to take all the pain on here and even more pain here. So instead of hedging against the euro or anything else, I just bought more. So I bought more down here, averaged in, finally got out about here, and took a hit, but I didn't take the hit down here. So I would have been quite heavily offside here, but because I'd averaged in here and here at these good levels, just above here and here, I got out for a 4% loss, but it could have been 15% if I had not done that. So I hedge by averaging in the same position to a trader to understand. We'd seen 1, 2, 3, 4, 5 big selling candles, rejection. I really thought the market was going to spike up back to here, but didn't. So I took a loss on the chin like you have to, but it certainly wasn't as big a loss as I could have done. So that's just an example of how I trade. Then the market came back up here, which means I probably could have scratched the trade if I'd left it pretty much all day, but I wasn't willing to do that. Then the market has done nothing but sell off. So again, we've seen a big, nice level here. So the market might find some final support here and bounce back up. If not, the market's going down into no man's land. Still think there's a lot of value in the pound, to be honest, so I wouldn't expect it to fall too much further just yet. But this is probably on speculation that if the Fed don't put rates up this year, then it'll probably be end of 2016 when the UK put rates up. And I don't believe that either. Rates have to go up. They've been down for too long. We've created too many problems, so rates have to go up this year or first, second quarter next year. Otherwise, you know, as a world, we're being thoroughly irresponsible. But good question, Matthew. Good question. You know, it's always good to ask these things. You know, just because I don't do them doesn't mean it's not right for other people. But I'd say high six-figure accounts can hedge because you get the benefit from it. Can you give more details on positive average when you consider it? Yeah, absolutely. I mean, again, I go back to something like probably the euro dollar. Okay. So the euro dollar, I mean, again, it depends. Negative and positive averaging are opposite things. So if I'm positively averaging, I'm going with the trend. So I'm always been a seller of the euro. I've told you this. I don't think the eurozone's fixed. I think it's broke forever. So as the market goes down in the hourlies, what I look for is things like this. Okay, on the 15-minute charts, selling, 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 selling. Or we buy it, reject buying it, reject buying it, buy it a bit more. Okay, so what I think to myself is, well, you know, again, if this little move was certainly not back to the 50% from here to here. Okay, 50% of this move is here. So we're holding low in this little series of 15-minute down candles. So as we go up, as long as we don't go back into the range, I would negatively average sell. So I'll be selling here, 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 and all the way up to these levels here, and waiting for this move to continuation. So we've seen all these selling candles. We've not been able to get back to the 50% of them selling candles. We've seen a little bit of green, yeah, no real positivity. So I'd be selling, yeah, while we don't see positivity, expecting this down move to continue. So that would be negative averaging. Positive averaging, yeah, would be selling all the way here, yeah, selling about here, letting the market come down. But as it goes up, I'm selling more because I'm still on side and I'm going with the trend. So negative and averaging just depends what your outcome is. If I'm just selling here as it's going up, yeah, I'm negatively averaging knowing that it's going to come down. If I'm positively averaging, it's because I'm already short into that position. I'm adding more into the direction of the move. Okay, so that's how you do it. Do I use Ichimoku clouds? No, I don't, Terence. I never use them, unfortunately. I've tried them out like everybody else has, and you know, I'm sure, you know, in my early career, I thought there was the answer to everything, but no. What I use is RSI, Bollinger Bands, and Fibonacci. So we see the euro getting higher now. So let's just look at other markets. The euro is going higher. That means the pound against the dollar should be going up. That means that should be coming down. The gold should be going back up. So the market's doing as we think. Okay, as the euro comes back, the dollar weakens, gold goes back up, okay, and the pound should go up also. So again, look at these correlations. That's a good understanding. Why is the euro going up? Because people are buying it? Absolutely. But why else? 1, 2, 3, 4, 5 hours of selling, a good level here, so profit taking. So look at the euro, sold off, sold off, sold off, so now people are cashing in. A couple of green candles. Yeah, it might not stay up for long, but that's a good example of buying bottoms. Phew. All right, guys. Well, like I said, that was a fairly an intense session. We've gone through a lot, guys. So it's recorded, so you can go back through it. But don't forget the basics. Just because the market tells you there's a lot of fear, that the VIX is up, there's a lot of volume, a lot of volatility, doesn't mean it should affect your intraday trading. If you keep your risk-reward ratios, you know, the same, or you keep them in tune with the volatility, that's good. If you just trade a little bit less size and average, that's a way of dealing with volatility. Volatility is good. Lack of volume sometimes is bad. Okay, the VIX is fairly irrelevant. So for me, all you've got to do is figure out what the markets are trying to achieve, understand the risk-reward ratios, understand what you're trying to achieve, and if you don't get the most out of the moves, doesn't matter. It's just about making money, banking the money all along. Yes, Jim. Always good to see you, matey. Yes, I know you've ordered the book, and like I said, I think mid-September it'll be ready for everybody to buy. You can pre-order it now. Just Google The Rough Guide to Trading. It's on Amazon, Harriman House. I've got a copy on my desk, like I said. I've got my author copies, so it looks good. It looks good, guys. You know, there's a lot in there. You can take away, read at your leisure. These sessions are lots of information, lots of things happening. But who else does webinars, and makes money on the side for you? Again, what I do, is try and back up my theory with real world experience and real world trading. There's no nonsense here, there's no lying, no smoke and mirrors like there are on, other trading sites. I'm the real deal. Okay, and as long as you keep supporting me, coming to the webinars, I'll keep supporting you guys and giving you all I can. All right, guys. Well, I know it's been a long hour. I don't want to keep you because I know it's the afternoon. Anything you want else, guys, get me on Twitter at Steve Ruffley, or the email address. You should know it by now. All right, guys. Well, hope you enjoyed this kind of impromptu session, and I hope you're not too frightened by the big bad BBC and their interpretation of volatility, VIX, and volume. All right, guys. Hope you enjoyed it. It's been a pleasure. Speak to you all very soon. Thank you.